Assalamu alaikum wa rahmatullah. Hello everyone and welcome again in our YouTube channel Business Mindset with Amin. Throughout this video we continue to talk about the balance sheet as one of the financial statements that the company has to establish. So let's go. So based on the decision dated on July 26, 2008, published in issue 19 of the Algerian Official Journal on March 25, 2009, the balance sheet should be structured as follows. So as you see here, this table represents the balance sheet. The right side of this table represent the liabilities or the element of the liabilities, and the left side represents all the element of assets. So as you see here, the assets, we have the no current assets and the current assets, and in the side of liabilities we have the shareholders equity and no current liabilities and current liabilities. So now I will try to provide you some details or some definition of or about all the elements of assets, shareholders equity, and liabilities. I try to define you to give you definition about some difficult words that can help you to understand well the balance sheet. So we start with the asset side. So in the asset side we have the fixed assets or non-current assets. These assets are resources with expected life of greater than 1 year. We can find three major parts of fixed assets. Tangible assets are assets that are physical in nature and have long-term presence in the operation of a company, such as land, building, equipment, assets in progress. We have also intangible assets. As definition, intangible assets are economic resources that have no physical presence. They include copyrights, trademarks, goodwill, and so on. So for the goodwill is associated with the purchase of one company by another, and it is in the case when the purchase price is higher than the fair value of visible and tangible assets. However, the financial assets are the long-term financial instruments such as stocks and bonds and other types of securities. Deferred tax assets, and they are valued according to the current price, it means the market price, on the relevant market. So the deferred tax assets, it's kind of a tax. It represents taxes that the company has overpaid. As with deferred tax asset or tax asset to present the tax income. It's just for the tax income here. So we move now to the current assets. The short term, this current assets. It's like the no current asset, but here is the short-term economic resources that are expected to be converted to cash or consumed within 1 year, such as inventories like raw materials, final products, customer or account receivable, note receivable, or cash and cash equivalents. So cash and cash equivalents are the most liquid current assets. It includes cash, like bank account, or can be converted to cash immediately, like commercial paper, short-term government bonds. Now we move to another side, or to the right side. So here we talk about shareholders' equity. As definition, the shareholders' equity is the difference between assets and liabilities, and it represents the remaining value of all assets were liquidated and all liabilities were paid off. We can find in this section issue with capital not called, net income, retained earnings, reserves, and revaluation. So I try to give you or provide you some definition about some difficult words, like issued capital is the total value of shares that company has issued to its shareholders. Capital note call represent shares issued without definite agreements on payment terms. Retained earnings are the accumulated portion of profits and are not distributed to the shareholders, but instead are reserved for investment back into the company. For the liabilities, we have no current liabilities, are the debts that the company owes but is not to pay for at least 1 month, such as long-term loans, deferred tax liabilities, and provisions. Deferred tax liabilities are future tax obligations that are payable and due in the future because haven't been paid in the current financial year. For the provisions, it represents funds put aside by the company to cover anticipated losses or expenses in the future. For the current liabilities, the company's short-term financial obligations that are due within 1 year or within normal operating cycle. We can find in this section suppliers or payable accounts, note payable, taxes payable, or dividends payable. Now we move to another question here. So is the balance has the same meaning as equality? So most of students here they think that the balance in the balance sheet is the equality. It means that assets is equal to liabilities, but it's not the same meaning here. So now we have to understand what does mean the balance. So the balance in the balance sheet doesn't refer to the equality. It indicates that no current asset, means the fixed assets, will be financed by long-term funds, while current assets will be financed by short-term funds. This distinction highlights how companies' assets are supported by different types of financing, ensuring a proper match between the duration of the assets and their funding sources. This alignment is crucial for maintaining financial stability and liquidity. Now, we move to another question here. What are the most important pieces of information when analyzing the balance sheet? So, when we analyze the balance sheet, we can take out some pieces of information. So we have to know what are these information. So examine the short-term liquidity position. So what does mean the short-term liquidity? It means the ability to the company to maintain resources so that it can meet emergency cash demand, for example, paying employees or repaying loans. Another information here is to analyze the capital structure of the company. It means here, what does mean the capital structure? It means how the company finances operation and growth by combining debts with equity. That's what does mean here the capital structure. Another information is to examine the solvency of the company or the financial solvency. It means the ability of the company to meet its long-term debts and financial obligations. So it's not like it has the same meaning of liquidity, but liquidity we can say it is related to the short-term debts or the ability to meet the short-term debts, but the solvency here is the ability of the company to meet the long-term debts. Now we have to understand what are the indicators of balance within a company. So in order to judge if the company is in balance, so we have to calculate some indicators. So we have 3 major indicators the company has to calculate. We have the first, working capital. WC. So what does mean working capital is the surplus or the excess of permanent funds, it means the shareholders' equity plus no current liabilities, after finance or cover all the no current assets, which allows the company to finance its operating cycle. So the formula here, we have two ways to calculate the WC. The first is difference between permanent funds minus no current assets. It's calculated throughout the above of the balance sheet, and we have throughout the below of the balance sheet means the current assets minus current liabilities. It gives us the same results here. So the WC here, it could be positive or negative. So what does mean positive WC and what does mean the negative WC? So for the positive WC, this means that permanent funds are sufficient to cover fixed assets, it means there are no current assets, and indicating a surplus in the investment cycle. The surplus serves as a safety margin with which company finance its operating cycle. However, the negative WC, this means that the permanent funds are able to finance a part of fixed assets, and the other part will be covered by short-term debts. So in this case, there is no surplus margin which allows the company to finance its operating cycle. Another indicator is the working capital requirements, WCR. So what does mean here the WCR? It is a financial metric showing the amount of financial resources needed to cover the cost of production cycle, upcoming operational expenses, and the repayment of debts. In other meaning, it shows the amount of money needed to finance the gap between payment to suppliers and payment from customers. The WCR we can calculate throughout the inventories plus accounts receivable minus accounts payable, or the current assets minus cash assets, minus, between brackets here, the current liabilities minus cash liabilities. So when you calculate the WCR, don't forget to put the brackets between the current asset minus cash assets and the current liabilities minus cash liabilities. So as the WC here, WCR could be positive or negative. So positive WCR means that the company needs funds to finance its operating cycle. This needed may be due to several factors such as a long payment or stock turnover period. Or negative WCR means that the short-term debt exceeds the current assets. So the company hasn't short-term financial requirements. However, it has a surplus in the short-term debt. Here, what does mean requirements in the operating cycle? It means the company has to pay employees, has to buy the raw materials, the goods, has to pay taxes, has to pay suppliers. That's what does mean the requirements in the operating cycle. The third indicator here is the net cash. What does mean the net cash? Is the difference between the cash assets and the cash liabilities. So for the cash assets, we can find a bank account and cash advance. Cash liabilities is the customer's deposits, bank overdraft, and cash advance. So bank overdraft, what does mean here? It's when there isn't enough money in a bank account to cover all transaction or withdrawal, but the bank allows this operation anyway. Here in the net cash, we can calculate through two ways. So the first is difference between cash assets and cash liabilities, or working capital minus working capital requirements. But here, the net cash, when you calculate the net cash, you have to calculate through the first way. It means the cash assets minus cash liabilities. And the second way is just to confirm that the working capital, that the net cash is equal to for the first, and at the same time you confirm that the working capital and the working capital account that you calculated before give us the right results from the balance sheet. Now, the net cash could be also positive or negative. When the net cash positive, it means that the WC capital is higher than WCR. What are the cases that WC could be higher than WCR? Here we have the WC could be positive and WCR could be positive. WC could be positive and WCR could be negative. WC could be negative and WCR could be negative. Net cash could be negative also when the WC is less than WCR. Also, there is several cases when the WC negative, WCR is positive. When WC negative, WCR negative, and WC positive, and WCR is also positive. So, here we have to know what are several causes that make the net cash negative. So, first, lead time for selling inventory. So when the company produces a certain quantity of goods, it often takes time to liquidate this inventory. So the result is a time lag between the point when money is spent on production and the cash flow in after the goods or the services are sold. The second cause is customer payment period. It means the company often have to wait a while of time before receive the amount of money from the customers. This means that the company can spend money to produce or provide services but may not receive the amount owed to it for a period of time. Also, another cause here is it means the payment period for suppliers. The company often relies on suppliers to source raw material or to finance the raw materials needed to the production once the production cycle has started. The company is indebted to this external party for the period that it takes to receive the money from selling its products or services. In certain circumstances, suppliers may claim a payment before the company has received sufficient funds to cover its costs. So, thank you for watching. Don't hesitate to subscribe in our channel and see you next time, inshallah, with